CPI data comes out at 8:30 a.m. Eastern time. For insights on how the inflation report could impact the Fed and the markets, let's bring in Michelle Girard. She's head of U.S. strategy at NatWest, as well as the CEO of NatWest Markets. And covering the equity angle is Carol Schleif, Chief Investment Officer of the BMO Family Office. We just said, actually, Michelle, there might be a 2 handle, but you think it's a 3 handle. Just misses?
Well, on the year over year, I think we don't have the core CPI rate getting down. And that's, I think, what we're focused on more than the headline number, right, below 3 and for a couple more months. I will say, the Fed's more closely watched measure of inflation, that PCE deflator, that does have a 2 handle. And we actually think on a excluding food and energy basis, that core PCE inflation number, which, again, the Fed is watching closely, could be down close to 2%, not just a 2 handle, but 2% by the middle of the year. And that I think has pretty big implications for what the Fed may be doing this summer.
Break down exactly what goes into the number that we see today, Michelle, because certain people raise prices at the beginning of the year, don't they? There's contracts and things like that. So this is usually a little hotter than what you expect.
That's exactly right, Joe. These figures are seasonally adjusted, which means that all of those things that happen at the same time every year should sort of get adjusted out so you can get a kind of a cleaner read. But there is some what we call residual seasonality, which is despite the best efforts to do that, we do tend to see higher readings in January and February, as at the start of the year, you see some contracts renegotiated, prices increased, and that seems to put some upward pressure on these inflation figures. So we've got a 0.2 headline gain, a 0.2 overall gain in the CPI, expected a 0.3 excluding food and energy. But we see some upside risk because of the fact that at the start of the year, sometimes you do get these upside surprises.
So, Carol, the NASDAQ's down over 100, down triple digits, and there's, I guess, a little bit of a wait and see, even though we keep hitting new highs in some of the averages. What's the market expecting? And I mean, in the market itself, which has hit all these new highs, a moderating inflation picture is already sort of baked into the cake.
Yeah, it definitely is baked in. So the markets will watch carefully each individual economic statistic, but the Fed has definitely told us that one statistic isn't going to be the magic number that allows them to start cutting inflation, that they're going to look for that continued accumulation of data. So hopefully the trend in the CPI is supportive both on the core and on the absolute basis. But markets definitely are hinging on all of the data. The Fed's pointed us in that direction, but we do suspect that you'll see continued disinflation, and it'll be supportive, along with all of the other things going on economically, of a continued strong stock market for the year.
What happened to that last mile that was going to be so hard? Do you think it's going to be just linear? We're just going to get down to 2, and we're not going to get stuck anywhere? Carol?
No, we don't. We definitely don't think you'll see a straight line. You'll see a lot of volatility in there. It's one of the reasons why we're hopeful that longer term investors don't focus on each and every data point, but take the combination of all of them and look at the trends moving in the right direction. Also, listen to companies. There was a lot of commentary in that could be extracted out of recent earnings reports related to companies right-sizing businesses and stocks getting credit for that, but also watching that pricing power and pricing sensitivity. We think a lot of companies have reached the max or gone a little bit beyond the max of where that pricing power is and what consumers will bear. And so there's a lot of information, not only the headline economic numbers, but also buried in those stock or earnings reports, stock and earnings reports.
I want to get back to Michelle in a second, just to get to the, where the residual inflation is really coming from. But just one more question, Carol. Were you ever at 7 rate cuts starting in March, or were you always skeptical? Why did the market take the disappointment that it's not going to be that easy?
We were never quite sure. Yeah, never quite sure how the market got so carried away back in November and December, assuming both early cuts and that many. And actually, you don't want that many, nor did you want it starting that early, because that would be much more indicative of an economy that was coming to a much harder landing. And so stretching those out, and we always expected late summer or late spring, early summer, sometime in there to see the cut. But we do think the trajectory is there, and that the Fed, and including many of the individual governors as they've spoken, has said pretty clearly they think they're through raising, and that should be a positive for intermediate term investors.